Thank you for joining me for today's episode of the Simply Financial podcast. I'm your host, Christopher Calandra, and would like to increase your financial IQ with today's episode. I've talked a lot about inflation, Fed policy, and interest rates on the show over the last couple of years. It's also been a recurring theme as the team and I here at Osaic Wealth Management meet with clients, helping them with their investment planning and their financial goals. And I believe, all of us here at Osaic Wealth Management believe that inflation, Fed policy, and interest rates are a central issue for the economy, thus by an extension for the markets in general. So let's just do a quick summary review of what's happened over the last stretch. To begin with, inflation ran hot. Became a huge topic in the 2021-2022 period because inflation got very high, the likes of what we have not seen since the early 1980s. Then, although they were slow to get started, the Federal Reserve acted aggressively to combat inflation. They raised interest rates as fast as they ever have in their history. The result of that was inflation coming down faster than most people bargained for. And that decline in the growth of inflation, or the rate of inflation, allowed the markets to rebound towards the end of 2022. And that rebound has continued generally in the stock market through the recording of this episode. Additionally, the country avoided a recession, one that was widely expected and talked about, but never actually materialized. All of this led to a situation where in late 2023, expectations changed. They changed quite significantly, where instead of expecting federal rate increases, where interest rates stopped being expected to go up, but expectation turned around, where in 2024, expectations were for interest rate cuts because the Fed had done such a good job with their activity and inflation had come down so quickly that rate cuts were on the horizon for 2024. And that was conventional wisdom in late 2023 into early 2024. A lot of prognosticators were expecting that the Federal Reserve might cut interest rates as many as 5 times in 2024, with a lot of estimates anticipating that the rate cuts would start as early as March 2024. Well, that has not happened. As of this recording, that has not happened yet, at least, because what has occurred is that inflation stopped declining. I should say the rate of inflation stopped declining. I'm going to talk a little bit about inflation speak towards the end of this episode, but inflation stopped declining. So it has gotten stubborn. It's dug in. Inflation went down a lot, but now it seems to have leveled off and even ticked up a bit. So it's right now about 3.48%. Compared to last month, it was 3.15%. That's that tick up I just referenced. But compared to last year, it was 4.98%, comparing month over month compared to 23 to 24. So that shows exactly what I'm speaking about. Inflation came down, but it has ticked up and it's leveled off, such that once again, expectations for interest rates and federal policy have needed to be adjusted. And that's what we've seen over the first 4+ months of 2024. The new expectations are far ranging, but I think generally expectation is for one rate cut at some point in the second half of 2024. But there is a growing contingency that thinks either there won't be a rate cut this year. Keep in mind, this is a big departure from as many as 5 to now a lot of people thinking 0. Additionally, and a little more worrisome, is a growing contingent of prognosticators, people that I follow, economists, media people, finance people, that think actually the Federal Reserve's next move is actually going to be a rate increase. Now, that would be a shock. That would be a shock. And that would be a departure from what the Fed has been telegraphing in terms of what they're going to do. But I think all options are on the table. The team here at Elliott Wealth Management, we had a recent meeting and we kind of polled one another. This is a normal meeting where we call it an investment committee meeting. We have them monthly, sometimes more frequently, but at least monthly. And we were consistent with the consensus, with the idea that one rate cut. I think I was at the latter end of when I thought it would happen. I think it'll happen in November or December this year. Some thought it would be more in the early fall. But that's kind of where we are internally here at Elliott Wealth Management. And that's pretty, again, consistent with the general consensus, although there's a lot of varying opinions on the subject at this point because we're in a period of change and quite a bit of fluidity. So what does this mean? What's the summary? The Federal Reserve has used the term higher for longer for a little bit now. And I think that phrase has proven to be true and has gotten truer over the last couple of months. The idea of higher for longer is that interest rates will be higher for longer, especially compared to what a lot of people were thinking or have thought or are currently thinking. This is not a surprise. If you're a client or affiliated with Elliott Wealth Management, we posted some economic update webinar broadcasts in January of this year. And my position at the time, and it still is my position, that the Federal Reserve would take its time. It was under no pressure. I never really bought into the 4 or 5 cuts this year. It seemed like that would be too reckless for the Fed to do, that they could take their time. They did some really good work in the early going, and that they could take their time and there would be no rush. And so that's kind of our thinking. A lot of people have come around to that thinking over the last couple of months. And I think that that's very healthy. I think it's fine. It's not worrisome at all. I'd like to see inflation come down some more, but it's not nearly as problematic as it was. The risks have come down dramatically. The damage that inflation can do has been mitigated. Still a problem, a stubborn one, but I feel good where we are. Before I let you go, let me talk a little bit about inflation speak, because I, like a lot of people, will say inflation is coming down, and that's sort of a shorthand term. When I say inflation is coming down, I'm really saying more technically that the rate of growth is coming down. And most people in the media will use this shorthand because it's just cleaner language, but it's not necessarily the most accurate language. So as an example, earlier in this episode, I talked about last year inflation was at 4.98% and it's come down. It's now 3.48%. That's the shorthand. What I'm actually saying more technically, more accurately, is that last year the price of goods and services were going up on average 4.98%. And now they are going up by a lower growth rate, that being goods and services are now going up by 3.48%. So it came down from 4.98 to 3.48. But that does not mean that prices are going down. They're still going up. They're just going up by a slower rate than they had been before. So keep that in mind. Now, the media, I don't like the media generally, but I find them to be very illiterate when it comes to financial matters and economic matters. And even if they're not, then they might just be purposefully misleading. I don't know. But I'm pretty sure a lot of media people don't know exactly what they're talking about when they throw around these terms. But I want you to be armed with the right way to look at it. When someone says inflation, the rate of inflation is coming down, or inflation has come down, what they are saying is the rate of growth has come down. We do not have negative inflation, which is called deflation. Deflation is the economic occurrence where prices do go down. They are not going down on average in the United States. They continue to go up. They are just going up by a slower growth rate, a smaller percentage than they were before. Now, politicians will often mislead and use the wrong terminology, again, either to mislead or maybe they are ignorant too. I know recently President Biden talked about how inflation was coming down and he wanted to promote that and take credit for that, which is fair game. But then he kind of conflated that with prices are coming down. Inflation coming down and inflation coming down are not interchangeable statements. The rate of inflation coming down is a true statement. Prices coming down is not a true statement, not using averages or broad indexes or government data. I'm sure we could find some products and some services in the economy where prices are coming down. But generally speaking, by and large, the cost of goods in the United States have gone up a lot over the last couple of years. They continue to go up, but they're going up at a slower growth rate than they were before. So I just want to touch on that inflation speak to make sure that we're all on the same page and that you are an educated citizen, as well as when you think about money and finances in your household budget, that you have a good or better handle on the terminology. Thanks for listening to today's episode. I'll be back with you on the next episode of the Simply Financial Podcast very soon. Thank you for listening today.
The views expressed are not necessarily the opinion of Osaic Wealth, Inc., and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. Past performance is not a guarantee of future results. No strategy can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information should be relied upon when coordinated with individual professional advice. Please note, the information being provided is strictly as a courtesy. When you link to any of the websites provided here, you are leaving this website. We make no representation as to the completeness or accuracy of information provided at these websites. Nor is the company liable for any direct or indirect technical or system issues or any consequences arising out of your access to or your use of third-party technologies, websites, information, and programs made available through this website. When you access one of these websites, you are leaving our website and assume total responsibility and risk for your use of the websites you are linking to. Securities and advisory services are offered through Osaic Wealth, Inc., member FINRA, SIPC. Insurance services offered through Elliott Wealth Management Services, LLC, not affiliated with Osaic Wealth, Inc.